simple truth of index funds, John Bogle's Common Sense Investing Story. The Little Book of Common Sense Investing Part 1. At 11 o'clock at night, a boy was looking at his salary slip. The money was in the account, but the fear of the future was bigger than that. FD felt safe, stocks risky, and mutual funds confusing. An ad flashed on the phone, choose the best fund, build wealth. But he had a question in his mind, who really chooses the best fund? An expert, luck, or some simple rule that people consider boring? This is where John Bogle's story begins. He taught the investment world a straightforward thing: there is no need to beat the market every day. Sometimes, victory lies in walking patiently with the market. John Bogle's book, The Little Book of Common Sense Investing, explains exactly this to the common investor. Looking smart in investing is one thing, and actually getting a good result is another. This book is for every person who wants to learn investing but is afraid of charts, tips, and headlines. It is also for those people who want more long-term growth than what a bank offers. But one thing should be clear: bank interest and market returns are not the same. There is more certainty in a bank, while there is a possibility of growth in the market, but risk also goes along with it. First of all, let's understand what a share is. When a company wants to grow, it needs money. It can get that money from a loan, or it can sell a small portion of itself in the form of shares. The person who buys a share becomes a small shareholder in that company. If the company becomes strong, the share value can increase. If the business becomes weak, the value can fall as well. This is exactly what makes direct stock investing difficult. From the outside, a company might look good, but debt, competition, management mistakes, or an expensive valuation might be hidden inside. A common investor cannot read the balance sheet of every company. They cannot understand every industry. They cannot track the results of every quarter. That is why many people choose the path of mutual funds. In a mutual fund, a lot of investors put their money into a pool. Then the fund manager invests that money in different companies or securities so that the money does not get stuck in one place. The fund manager's job is to find good stocks, avoid bad stocks, and try to give a better return than the market. Listening to this, it sounds very logical and trustworthy. But Bogle raised a question. If thousands of experts in the market are trying to beat each other, can everyone become a winner? In front of every extra victory in the market, there is also a cost somewhere. He put this very thought into his famous line, "Don't allow a winner's game to become a loser's game." Meaning, business ownership can build wealth, but high costs and wrong behavior can spoil the game. Understanding index funds and managing costs. Now understand what an index fund is. An index fund is a fund that copies a market index. Like the S&P 500 in America and Nifty 50 or Sensex in India are popular examples. If a fund tracks Nifty 50, its goal is not to heavily beat Nifty. Its goal is to give a performance like Nifty in a low-cost and rule-based way. In an active mutual fund, the manager chooses which stock to buy. In an index fund, the rule is fixed beforehand. The fund mainly follows only those companies that are in the index. Its benefit is simplicity. The investor does not have to guess which manager will remain a genius for the next 10 years. They simply take part in the growth of the broad market. Now the question comes, how can an index fund be better than an expert manager? Its answer is hidden in the fees. The market gives a gross return, but the net return comes into the hands of the investor. Research, trading, management, and distribution costs can be higher in active funds. Index funds follow rules, so their cost generally remains low. In the long term, this very difference becomes big. Suppose two people invest in the same market, one in a high-cost fund, the other in a low-cost index fund. In the beginning, the difference will look small, but with compounding, fees also compound. John Bogle used to say, an investor cannot control market returns. No one knows whether the market will go up or down next year. But an investor can definitely control cost, discipline, and patience. Vanguard's philosophy was also built on this very idea: goals, balance, low costs, and discipline. These four words show the common investor that investing is not glamour, it is a game of system. John Bogle started Vanguard in 1975. Later, the Vanguard 500 index fund became a big turning point for retail investors because it gave common people a broad exposure like the S&P 500. Today, Vanguard is among the biggest investment firms in the world. But Bogle's real legacy is not just the size of the company. His legacy is that investing can be fair and simple for the common man. Now listen to the Warren Buffett story. Buffett placed a famous long-term bet against hedge funds. His belief was that a low-cost S&P 500 index fund, after fees, would do better than selected hedge funds. This bet ran from 2008 to 2017. It started with the financial crisis when the market fell heavily. In the beginning, hedge funds felt safe, but by the time the decade ended, Buffett's index fund side won. This does not mean that an index fund will beat every strategy in every period. There is no guarantee in the market. The lesson is that complexity and high fees do not give a guarantee of a better result. For an Indian investor too, the question is the same. Which stock will become a multi-bagger? Which sector will boom? Which fund will remain top? Bogle would say, first become a part of the broad market. Index fund gives diversification. If one company goes bad, the entire portfolio does not finish. The index keeps changing according to its rules, so the balance of weak and strong companies can adjust with time. With this, the investor has less need to look at the news every day and panic. They do not put their entire hope on one company or one manager. They own a market basket. Mitigating risks and the power of behavior? But an index fund is not risk-free. If the stock market falls, the index fund also falls. Nifty or S&P 500 do not give guaranteed returns like a bank FD. An index fund does not eliminate risk, it spreads risk. Company risk is reduced, market risk remains. Therefore, it demands long-term patience, not short-term excitement. Bogle used to talk about avoiding speculation. Speculation says, buy quickly and sell quickly. Investment says, become a partner in the long-term growth of good businesses. This is a difference of mindset. A trader takes a decision by looking at the colors on the screen. An investor takes a decision by looking at their goals, time horizon, income and risk capacity. An index fund makes the second path easy. Think of a common man's life: job, family, children's education, home loan and medical emergency. He cannot become a full-time analyst. He needs a simple system of investing. If he puts money into a broad index fund in a disciplined manner every month, the pressure of market timing can be reduced. SEP can form a habit, but patience is still necessary. Active mutual funds are not completely wrong. Some managers can do better than the benchmark during good periods. In some categories, active management can be useful as well. But Bogle's point was that choosing a long-term winner beforehand is very difficult. The fund that is top today might not necessarily remain top in the next decade. Past performance is not a future guarantee. In choosing an active fund, one has to understand the manager, strategy, risk, fees, turnover and consistency. In an index fund too, an inspection is needed, but the questions become simple. Which index, how much cost, how much tracking error? Tracking error tells how closely the fund is following its index. A low expense ratio is good, but tracking quality is also necessary. Just being cheap is not enough. Now understand the hidden enemy, emotion. When the market falls, fear comes. When the market rises, greed comes. Seeing someone's profit story on social media brings comparison. John Bogle's common sense says that remaining boring can sometimes be profitable. Taking actions repeatedly gives an illusion of control, but every action also increases the chance of a mistake. Index investing teaches humility to the investor. It is difficult to consistently beat the market. Therefore, apply your energy to those things that you can control. You can control the savings rate. You can keep debt low. You can build an emergency fund. You can protect your family with insurance. Then you can make long-term investing a disciplined habit. A big mistake is that people mistake investment for quick income. An index fund is not a machine to make you rich overnight. This is a slow engine, which needs time and consistency. This lesson is very powerful for young investors. When time is long, compounding gets room to breathe. But if you exit at every fall, compounding breaks down. The lesson is different for older investors. It is not necessary to put all the money into an equity index fund. A balance of equity, debt, cash and safety is necessary according to the life stage. Therefore, an index fund is not magic, it is a strong building block. Just as a foundation is necessary in a house, a low-cost broad market exposure can become the foundation in a portfolio. Staying the course. The mutual fund industry sometimes sells hope. Hope is not wrong, but expensive hope can be dangerous. A high fee is right only when the long-term net return is truly better. Bogle used to say, in the investment business, the market builds the gross return but the investor gets the net return. The more charges and transactions there are in between, the more the investor's share can decrease. Another problem is the behavior gap. The fund performs well, but the investor earns a poor return by making entries and exits at the wrong time. Therefore, behavior is more important than the product. Index investing does not completely eliminate the behavior gap, but it can reduce it. Because the product is simple. The investor understands that he owns the market, he is not buying a magic trick. There are professionals, algorithms and research teams in the market. What is the edge of a common investor? Bogle's answer was patience, low cost, diversification and staying power. Staying power means holding on during a fall. If the money is for short-term needs, there is a risk of selling out of compulsion during a market fall. Therefore, goal planning is necessary. First an emergency fund, then high-interest debt control, then insurance, and then investing. This order looks boring, but in a financial crisis, this very boring system comes in most use. Understand an index fund like this. You are not fighting the market, you are sitting in the market's boat. The wave will sometimes go up, sometimes down, but jumping in a panic can become the biggest risk. If someone puts a little money every month, they can get more units in a falling market and fewer units in an expensive market. This habit can turn emotions into a process. But SEP is also not a guarantee. If the time horizon is short or if the plan stops during a fall, the benefit can decrease. The real partner of index investing is behavior. John Bogle wanted the financial industry to work for the investor, not the investor for the industry. Therefore, he emphasized low-cost, client-focused and common-sense investing. His message is special for ordinary people. You do not need to become a genius. There is no need to predict every headline. You have to adopt broad ownership, low cost and discipline. When a beginner asks, which stock should I buy? Bogle would probably ask, what is the goal? How long is the time horizon? How much risk can you handle? Will you be able to stick to a simple plan? The real question of investing is of personality before product. An impatient investor can get a poor result even from the best fund. A disciplined investor can make a strong journey even with a simple fund. The biggest lesson of this part is exactly this. An index fund is not a shortcut, it is a common sense system. Do not get caught in the costly race of beating the market. Take part in the growth of the market in a low-cost way. But the story does not end here. In the next part, the real twist will come when we see how expense ratio, fees and compounding can quietly make your wealth and also quietly eat it away.
If this video has taught you something new, or if you feel this information should reach more people, don't forget to like and share the video. Your small share can become valuable and useful information for someone else. If you have any questions related to this topic, or if you would like to share your opinion with us, be sure to write in the comment box. We read every question and suggestion from you, because your feedback inspires us to create better content. And if you want to keep receiving such interesting and reliable information about business, the economy, and the world in the future, then don't forget to subscribe to our channel GRT Business and also press the bell icon so that you get notifications of every new video directly. At GRT Business, we always strive to provide you with accurate, balanced, and reliable information. Our news and analysis are prepared based on information obtained from various news agencies, public sources, and public opinion. We make every effort to verify and validate each fact as much as possible. But in case of any possible error or dispute, the responsibility lies with the respective sources. Our only aim is to present you with a correct and trustworthy perspective so that you can understand any topic better.